Hello and welcome. Today we are going to be talking about the disadvantages of consolidating debts using a mortgage. So I've been doing this for 15, 16 years or so. So there are quite a number of disadvantages that I want to go through. I said I'd do a completely separate video on this, and that's exactly what we want to do because I want to really focus on this. So if you're considering consolidating debts using a mortgage, but you're sick of shelling out cash, on a monthly basis, whether it be loans or credit cards or whatever. You may also be thinking about doing some home improvements, maybe an extension or anything like that. But you think it might be a really good idea to perhaps get it all into one monthly payment, but you're actually concerned as to whether it's the right idea or not, then this may be the video for you. So we're going to dive straight into it and we're going to talk about all the disadvantages. We're going to do that right now. So it's obviously really important that you understand what the disadvantages are of using a mortgage to consolidate debts. So we're going to run through this really, really quickly. And if you've got any questions or comments, do just pop them below. Sometimes I can reply to them if it's a really simple comment. Other times it's a great source, and I can actually do another video on it and explain it in a bit more detail. So if you've got any questions, feel free to drop a comment. So just to cover the basics, what is consolidation? So consolidation is when you are taking a loan, whether that be a mortgage or another loan, and using the money from that loan to pay off other debts. So this is usually credit cards, loans, hire purchase, whatever debts you've got outstanding, catalogs or whatever else. Now, today we're going to be talking specifically about secured debt. So this would be mortgages, secured loans, anything like that, which is secured on a property. And what I mean by secured on a property is if you couldn't pay the loan for any reason, then your property could be repossessed, whether it be a residential property or a buy-to-let property or any others. So you've got to consider that there are other options available. So we put that nice and big on the screen if it lets me. So there are other options which you should consider, such as unsecured loans, credit cards, and those types of things, where you can other or potentially get another option paid off that way. Now, if you did take an unsecured loan, for example, you've generally got to take these over a shorter term than if you use a mortgage. Now, that generally will increase your monthly payments. So just bear that in mind. But you should also obviously always consider that before you make any commitments. Now, how can you use a mortgage to consolidate debt? Just to cover that really basic, really briefly, you basically, if you've got £50,000 currently outstanding on your existing mortgage, then what you would do is you would move the debt to another lender. And to do that, you take out another mortgage or another loan. You'd use some of that to pay the existing loan off, and then you would simply keep whatever is left in order to consolidate debts or do home improvements or whatever else. That's it in a nutshell. And that's basically how it works. So let's talk about the disadvantages of debt consolidation. Like I said at the beginning of the video, I've also done another video on the advantages of debt consolidation, but because there are also disadvantages, I wanted to make sure that we covered that in the greatest of detail, and I didn't want to make that video too long. So we will, if you want to check out the advantages, have a look on the YouTube channel. They'll also be available on the other social media platforms as well. So go and check that out. But today we'll just look at the disadvantages. So if you use your property to raise money to repay debt that you've currently got, so higher overall costs. So this is an interesting one because people often look at me and say, well, how does that work? Because if you've got credit cards, which are on, let's call it, significantly higher interest rates, we won't use the word criminal, but significantly higher interest rates than what you'd get elsewhere, then how can it possibly cost more if you're on a lower interest rate? And it's purely down to the time you take the loan over or the term you take the loan over. So for example, if you had, say, £10,000 outstanding on credit cards and you took it out on a loan and you paid that over 5 years, it probably wouldn't be a higher overall cost. It would probably be lower. So the amount of interest that you would pay depending on the rate of the loan, would generally be less. But if you took it on a mortgage and spread that over 30, 35, 40 years, and you do that in order to lower the monthly payments, if you're looking to have more disposable income on a monthly basis, then there's a great reason on its own that you'd want to maybe consider that. But overall, even though your interest rate is lower, you don't know what the interest rate's going to be over that 30, 35, 40-year period. And generally, even if they stayed exactly the same, because you've taken it out over that length of time, as a general rule, you're going to be paying more in interest. So before you do consolidate any debt, it's really important that you obviously consider that. Longer repayment period. So yeah, I basically just touched on that, where, if you do pay it off over a 30, 35, 40-year period, then there's a reasonably good chance that if you took, well, not a reasonably good chance, try that again. If you took it over a shorter period, then you would obviously get, you get it paid off quicker. It always comes down to budget. If you can afford to increase your monthly payments, then that's absolutely what you should be doing. It gets paid off quicker, because what's the point? What is the point in spreading it over a longer period just to get lower payments if you can afford to pay more? If you can pay more, you will pay less interest in the long term. So that's exactly what you should consider. The big one, the key to this is, because it's secured, you've got the risk of repossession. And again, that's probably worth putting nice and big on the screen, is if you take out a secured loan or a mortgage or any description, and you cannot pay the monthly payments for whatever reason, they can come along, or the lender can come along, and they can repossess the property. So they would basically take back control of the property and would probably look to sell the property on. And the important part of that is, when you're consolidating debt, so people generally consolidate sort of loans and credit cards and store cards and that type of stuff. As it is right now, those things are not secured against your house. So you don't have an immediate risk of the lender coming along and saying, actually, we want your house, we're going to sell it so that we can get our money back, please. So there is obviously that risk of repossession. It is right for some people in the right circumstances, which again is why you should always get advice around this to make sure that you are doing what is right for you. And it's understanding the options as well, because there may be another option that you'd want to consider, because there may be far better terms to it. Or you may just not like some of the disadvantages of this option. It's important that you use somebody that's going to be absolutely honest with you and not just tell you what the sort of what the benefits are, because there's plenty of cons as well, if you like. Next one then is risk of getting into more debt. So this really comes down to the individual. So if you are going to be consolidating 15,000, 20,000 pounds worth of credit card debt, generally what happens is we would raise enough money for those credit cards to be paid off. What we cannot do is make you close the credit cards. So, or no lender can, not just us. And so you're going to have those credit limits again to spend. Now, I've seen this happen, where we consolidate something and then we see them again in 12, 18 months time, and we've consolidated the original debt and they've run the debt up again. Now, that puts you in a far worse position than what it was originally. And simply because you've now got double the debt. So if you're getting to a point where you can't manage the monthly payments at the moment, or you're getting up to your credit limits or whatever, then you get into a position where you simply just won't be able to use any more credit. So if that's unaffordable, then we need to get you to a position where it is affordable. But you need to be really happy that you'd either cancel those credit cards, or you're not going to take out new credit cards, or you're not going to get yourself back into the same situation, because you'll be in a worse place. You might be able to consolidate this time, but next time the rules might have changed. You might be stretching your affordability this time, so next time it just will not be possible. You do not want to get into that position. So if you think there is any risk that you will not be able or to sort of control the spending, or the reason for the credit for the credit in the first place hasn't really gone away, securing it against your house probably won't help. It's just going to put your house at risk of repossession. So if you're sitting on the application forms at the minute, then pop them in the bin is probably the best thing I can say to you there. It's always good to have some sort of credit card, sort of as a backup if things really do go wrong. One of the sort of things I've seen before is you just got a small sort of little container, pop the credit card in, fill it with water, and shove it in the freezer. Because if to get that out and go and use it, you would need a little bit more time in order to defrost it or smash it apart, or however you're going to get it out. Just allows that little bit of thinking time. So as a little tip, if you want to ever try that. So yeah, if you're going to get back into more debt, just don't do it. So tips to make this make your application easier. Probably the best thing I can say is be open and honest, whoever you're dealing with, whether it be a mortgage broker or directly to a lender. Be open and honest with exactly what you're looking to do. There is so much criteria within mortgages. Honestly, the list is absolutely endless, and I've done another video on that elsewhere if you want to go and check that out. They've got criteria. There's rules for everything. So if you want to consolidate, for example, 11 debts, some lenders will cap that at 10. So, and they won't just not consolidate that one debt. If you have to consolidate that debt for the loan to be affordable, they'll just decline the case. So it's really important that you tell the lender everything right at the beginning, so to find out whether you qualify or not. And if you are dealing with a mortgage broker, again, do the same thing. Be upfront and honest, because that is the only way that we're ever going to be able to get to a point where we can make sure you've got the right advice, and things aren't going to fall apart sort of later down the line. Fees, I've touched on this before, so I'll just cover this really briefly. Some mortgage brokers do charge fees. Generally, the way that it works is you can either have something good, something cheap, or something fast, but you just can't have all three. But you can generally have two. So, for example, if you wanted something cheap and you wanted something fast, then it may not be very good. If you want something good and fast, it's probably not very cheap. It's just up to you as to what those things are, which part of that is more important to you, so that you can sort of make the right choice. And really that's all it comes down to. Is every mortgage broker is going to be completely different. The only time you're not going to get a broker fee is if you go directly to a lender. But just remember, although you will speak to a mortgage advisor, if you go directly to a lender, you are only ever going to be able to talk about that lender's products. Bank mortgage advisors cannot talk to you about any other lender's products. They can only talk about their own. So do you really know whether that is the right option for you? Apart from that, I think that's pretty much everything that we need to go through. If you have got any questions or comments, like I said, drop them in the comment section below, and I'll try and cover them in a future video. For now, thank you very much.